there is a bottleneck in the global machine. It's a physical choke point, a sliver of water where the lifeblood of the industrial world, oil, gas, the very atoms that power our modern existence, must pass. But the most important bottleneck isn't just a place on a map. It's a bottleneck in our perception. It's the lag between when a price changes in the world and when that change is felt in your daily life. Right now, in that narrow strait, a drama is unfolding, not just of geopolitics and vessel traffic, but of psychology. Cargo ships are hesitating. Tankers are holding position. And in that hesitation, the entire global economy is being quietly, methodically repriced. There exists a fundamental asymmetry in the financial world. It's not just about who has more money, but who has more time. The largest financial institutions, the ones managing trillions, don't react to the news. They position themselves for the conditions before the news becomes undeniable. They receive raw data, market intelligence, and geopolitical analysis in real time. Their wealthy private clients get the synthesized version of that data. Their hedge fund clients get the potential strategies. And what does the public get? They get the story, packaged neatly after the fact. They get the headline, the panic, and the confusing chorus of online voices assuring everyone that it's all going to be fine. They get the emotional residue of a decision that was made financially, days or even weeks ago. This gap, this lag between the institutional setup and the retail emotional reaction is where fortunes are quietly transferred. Let's examine the raw material of this repricing. A vital maritime artery is seizing up. The flow of roughly a fifth of the world's oil is being disrupted. To think of this as merely an oil problem is to miss the point entirely. Oil is not a single product you buy at a pump. It is the precursor to everything. It is the plastic in your computer, the fertilizer that grew your food, the fuel that shipped your clothes, the asphalt under your feet. It is the ghost in the machine of globalism. When a critical artery is compressed, the system doesn't just slow down. It begins a complex chain reaction of failures. Production facilities on the coastline don't have infinite space to store the oil they're extracting. They have days, perhaps a week, of storage capacity. When that fills, they have a choice: stop producing or find another place to put it. Stopping production at an oil field isn't like turning off a tap. It's operational damage. It can take weeks or months to bring a shut-in well back to full capacity. This is the psychological pivot. The market isn't just pricing in the disruption. It's pricing in the asymmetry of the recovery. Demand can return in a heartbeat. A factory can restart. A car can be refueled. But supply? Supply is slow, physical, and stubborn. Once supply is taken offline, the market becomes a pressure cooker, and the fear of that scarcity becomes more powerful than the scarcity itself. History whispers to us, even if we refuse to listen. In the 1970s, an oil embargo didn't just raise prices at the pump. It rewired the global psyche. It created a sense of fragility that lasted for decades. Today, the memory is faded, but the mechanism remains. The fear isn't just that energy will become expensive. The fear is that energy becomes a weapon, a source of national insecurity that forces governments to act in unpredictable ways. This fear travels. It doesn't stay in the Middle East or in Asia, where most of this oil is destined. Imagine the largest manufacturing economies: China, Japan, India, South Korea, being forced to outbid each other for the same dwindling pool of available barrels. They will dip into their strategic reserves, the emergency savings accounts of nations. At first, this calms the market. It's the government stepping in to say, "We have a plan." But as the disruption continues and those reserve levels visibly drop, the psychology flips. The market realizes that the emergency cushion is being consumed while the fire is still burning. The safety net is fraying in real time, and that realization injects a permanent, stubborn premium into the price of everything. Now, look at another signal, one that operates on a much slower, more deliberate frequency. For the first time in decades, the world's central banks are buying gold at a pace that outstrips their purchases of U.S. Treasury bonds. For nearly 80 years, U.S. debt was the ultimate safe haven, the anchor of the entire financial system. It was the asset that everyone trusted when they trusted nothing else. But trust is a psychological construct, and it is still shifting. The official statements from these central banks speak of diversification and risk management, but the action speaks of something deeper, a quiet hedge against a fragmenting world. It is a hedge against the possibility that the old rules, the old paper promises, might not hold the same weight they once did. For years, the average investor was subtly conditioned to see gold as a relic, a barbarous metal for conspiracy theorists and doomsayers. Yet, the very institutions that perpetuated that view were and are among its largest holders. They are not buying it because they are nostalgic. They are buying it because they are professionals whose job is to insure against catastrophic loss. They are buying insurance, and the premium is the price of gold. And where gold leads, its more volatile cousin, silver, follows. Silver carries a dual mandate in the market's collective mind. It is a monetary metal, a store of value, but it is also an industrial metal, critical for solar panels, for the electronics in our AI-driven future, for the very infrastructure of the modern world. When these two narratives align, a distrust in fiat, money, and a physical shortage in industry, silver doesn't just move, it explodes. It becomes a magnifying glass for all the stress in the system, amplifying both the upside and the terrifying downside. It is not an investment for the faint of heart, but as a macro signal, it is deafening. Then comes the final confirmation that the situation has transcended normal market forces, the response of the state. When you hear whispers of governments considering direct intervention in futures markets or invoking emergency powers like the Defense Production Act to bypass regulations and force more energy output, you are witnessing a profound shift. These are not the tools of a confident, functioning market. These are the tools of crisis management. They signal that the people with the most comprehensive intelligence believe the potential consequences, economic contraction, social unrest, political instability are too severe to be left to the slow, messy process of democratic bureaucracy or market discovery. They are preparing for a world where the usual rules are suspended, and when the state prepares, the market pays attention. So, what does this mean for the individual? For the person watching this, whose retirement, whose savings, whose sense of future is tied to this vast abstract system? The first and most important lesson is to understand your own psychology. The market is a story we tell ourselves about the future. In stable times, the story is linear and optimistic. In times like these, the story becomes fragmented and fearful. The instinct, when the story turns scary, is to act, to sell, to hide, to seek the comfort of cash. But that is an emotional response to a headline, not a strategic response to reality. Acting on emotion simply means participating in the market's price. Discovery at its most violent, most irrational stage. It means buying high on euphoria and selling low on fear. The institutional mindset is different. It is not about being right about tomorrow. It is about building a framework that can survive many tomorrows. It's about asking systematic questions. What in my portfolio is most vulnerable to higher input costs? Which of my winners are now dangerously concentrated bets? Do I own protection, or do I just hope the storm will pass me by? Hope is not a risk management strategy. It is a prayer dressed up in a spreadsheet. The disruption in the strait will eventually resolve, one way or another. The ships will move, the production will restart, and a new headline will capture the world's attention. But the structural shift it is a part of will remain. The world is becoming less efficient, less trusting, and more fragmented. The frictionless globalism of the last 30 years is giving way to something else, something more regional, more guarded, more expensive. Your portfolio doesn't care about your political views or your personal optimism. It responds to the hard data of flows, of risk, of energy, and of policy. It is a mirror reflecting the world as it is, not as we wish it to be. You don't need to be frightened by that reflection. You just need the clarity to see it before the light shifts, and the discipline to act on what you see, not on what you feel. Because the price of hesitation in a repricing world is paid by those who arrive last to the truth. Thank you so much for watching. Stay connected.